In a pivotal moment for the United States, Fitch Ratings, one of the world's most influential credit rating agencies, has dealt a significant blow to the nation's financial reputation. Cutting the U.S. debt rating from AAA to AA+, the downgrade comes as a stark warning, citing worsening fiscal conditions and governance issues plaguing the world's largest economy. This downgrade arrives just 2 months after political brinkmanship brought the country perilously close to a sovereign default, leaving global markets in suspense. In this introspective analysis, we delve into the reasons behind Fitch's bold move, the potential ramifications on the nation's borrowing costs, and the contrasting opinions from economic experts and policymakers. Join us as we explore the intricacies of this critical financial event and its impact on the nation's future trajectory. In May, Fitch Ratings made a significant move by downgrading the U.S. government's credit rating from AAA to AA+ due to worsening fiscal conditions and governance issues. This downgrade came just 2 months after a political standoff brought the world's largest economy perilously close to a sovereign default. Fitch's decision was based on its concerns about the expected fiscal deterioration over the next 3 years and the increasing burden of general government debt. They also highlighted a notable erosion of governance over the past 2 decades, characterized by repeated debt limit standoffs and last-minute resolutions, which had a negative impact on the government's credibility. Despite warnings in late May, the U.S. managed to avoid default projected for June when legislators and the White House reached a deal to raise the federal borrowing limit at the 11th hour. However, Fitch persisted with its downgrade, raising worries about the nation's long-term fiscal challenges. The downgrade was a significant move because it was the first time a major rating agency had downgraded the U.S. in over a decade. Such a change in credit rating could potentially impact the country's borrowing costs in the debt markets, though its specific effect remained uncertain. In response to Fitch's decision, U.S. Treasury Secretary Janet Yellen strongly disagreed with the rating change, calling it arbitrary and based on outdated data. Economist Lawrence Summers, a former Treasury Secretary, also criticized the announcement, arguing that the downgrade was bizarre and inept, especially considering the current strength of the U.S. economy. Fitch cited the growing U.S. debt burden as a primary concern. They projected that the general government deficit would rise to 6.3% of gross domestic product in 2023, up from 3.7% in 2022, mainly due to weaker federal revenues, new spending initiatives, and higher interest burdens. Despite the downgrade, the reaction in the markets was relatively muted. The U.S. stock market had already closed before the announcement, and both the markets for U.S. Treasury bonds and the dollar index showed little movement in response to the news. It's worth noting that Fitch is one of 3 major rating agencies, and Moody's still maintained a AAA rating on the U.S., while Standard & Poor's S&P had downgraded its rating to A+ in 2011 after a previous debt ceiling showdown. In conclusion, Fitch Ratings' decision to downgrade the U.S. government's credit rating reflects concerns about the nation's fiscal trajectory, political standoffs, and the increasing debt burden. The move has significant implications for the global market for U.S. government debt and may influence borrowing costs, but the full extent of its impact remains to be seen.